Hello everyone, welcome back. And today we're talking about the Shiller PE ratio. And this is also known as the CAPE ratio, or the Cyclically Adjusted Price-to-Earnings ratio. And this is a phenomenal tool that really should be used by essentially all long-term investors, just in my opinion, because of the value that this valuation metric provides for long-term investors. And I don't mean those who are trying to, basically build a portfolio for the next 6 to 12 months, but more for those who are trying to build a portfolio for the next 3 to 10 years. And this is a great tool to help understand the true multiple that stocks trade to earnings. So let's take a look at what we have here. So just as a overview, right, there's the traditional PE multiple, which we all know about. And the problem with traditional PE multiples is that they can be misleading. So traditional PE tells you the multiple that the stock trades to relative to earnings over just a 1-year time period. So we can have, trailing PE, which uses the last 4 quarters of earnings. You can use current year EPS, which uses analyst estimates for this current fiscal year. Or you can use next year's earnings, again, also analyst estimates. All three of them can be good. They can be, useful. But there is a major pitfall with using a PE multiple to make a determination whether a stock is expensive or cheap. And that is because it overemphasizes a single year's results. And remember, if you're in a recession, for example, or if you're in a boom period, for example, or if you're in a time where a specific company is going through a company-specific issue, then you can have earnings that are temporarily very high or temporarily very low. And so if you're using a PE multiple using a single period earnings, then that multiple is going to be misleading, and it's going to lead you to making an erroneous conclusion if you are a long-term investor. So remember, companies can go through both periods where growth is coming in far above trend, and that would overstate earnings temporarily. And you can also go through periods where companies, are generating earnings growth well below trend. So the idea is that if earnings revert to the mean eventually over the long haul, then using traditional PE is going to be misleading, especially when you're at those pivot points at the top or bottom of a cycle. So this is why traditional PE should be used in conjunction with other metrics. But the way to fix this is to use the Shiller PE. So the Shiller PE was invented by Yale University professor Robert Shiller. He's also the brains behind the Case-Shiller index for tracking real estate prices. And this is a phenomenal idea. So the idea here is that the calculation behind the Shiller PE is that we're taking a look at price today relative to the 10-year average real earnings per share. So this kind of uses two things in the denominator. It's using the 10-year moving average, and it's adjusting earnings for inflation. So what this basically is doing is that for every single quarter, we're basically calculating a rolling 10-year, essentially moving average. So if you can think of like a moving average on a stock price, right? We all have seen that before. If you look at like a 10-year stock chart and you put on a 200-day moving average. So you look at the stock price relative to that 200-day moving average. What that 200-day moving average does is that it smooths out the price trend over time and tells you whether is the stock in an uptrend. If so, then obviously that means that the stock is above the 200-day moving average, or is it below trend? And also, more importantly, what is the direction of the moving average? Is it heading up or is it heading down? So if the moving average is moving up, that means that the stock is in overall bull market. And if the moving average is moving down, then that means that the stock is in a bear market. So we're taking the same idea here, but applying it to earnings. So we look at, say, for example, the earnings of any specific company, and I'll just pull up an example here just to take a look. So we'll go over here into ZRS, and I just have Waters, Waters Corporation here. Now, Waters is one of our earning certain stocks. So their earnings basically just goes up in one direction all the time. But let's say, I don't know, let's use something a little bit more cyclical like CAT, right? Caterpillar. So they have these cycles, right? So if you were to use a moving average rather than using earnings here, because remember, PE is only going to look at earnings at one point in time. So what that means is during bull markets, you're going to look like the stock is going to look like it's very, very cheap, because remember, earnings are artificially high. It's at the top of the cycle, and the stock is basically, already anticipating that next leg down. That's what that's what the market typically does. But at market tops, you'll notice that the stock gets very cheap. And you can see that there. And then we go through a cycle where, earnings comes down, it troughs over here. And that's actually when the stock looks very expensive, right? So if you're using traditional PE multiples, you're going to get the exact wrong signals. You're going to be buying near the top, and then you're going to be selling near the bottom, because that's where the stocks look cheapest and most expensive, respectively. So how the Case-Shiller index kind of fixes this is that it uses a rolling 10-year moving average. Now, it takes the earnings and it adjusts them for inflation, right? So there's one step before that. But once you have inflation-adjusted earnings, then you use a 10-year moving average to those adjusted earnings. So then you can imagine if I were to overlay a 10-year moving average, that number is not going to be like as volatile as these earnings are. You're going to see a nice smooth trend up and down, maybe a little bit of a dip followed by a little bit of a recovery, followed by a little bit of a dip, followed by a little bit of recovery. So it'll look kind of like this, but if you were to minimize these peaks and troughs, that's what the 10-year moving average would look like. And so the Shiller PE wants to look at the price relative to where we are in that moving average of earnings rather than the actual earnings. So that would actually give you a much better picture of the true valuation of a company, right? Because you're not getting, you're not overreacting to, when we're significantly above trend, and you're also not overreacting to when we're in recession, for example. So we want to find sort of the normalized earnings that the company will exhibit over time, and looking at the multiple to that normalized earnings rather than having these extreme moves both up and down. So this Shiller PE does a great job of removing the noise that happens every couple of years, for example, in the case of Caterpillar. And it gives you a great picture as to when the stock is truly cheap and when it's truly expensive. So again, we look at the market or the stock multiple relative to real earnings that are normalized for events that are expected to be temporary. So as you can see here, going back in time, every single time we've had an earnings decline in Caterpillar, that's always been followed by recovery in earnings. Because remember, Caterpillar, as long as we're talking about companies that are best in breed, right, best in class at what they do, Caterpillar is not going to be displaced by anyone anytime soon, right? So as long as we have a company that is, best of breed, is the leader in their specific, industry, then every time you have a earnings trough, you're going to have a recovery when there is an economic recovery, or when there's a recovery of any other factors that is influencing their earnings stream, such as, for example, the dollar index, or currency translation gains and losses, things like that. So as long as the company is going to be durable, right? They produce a product or service that are always going to be in demand long term, then normalized earnings are the right way to look at the valuation. So again, traditional PE is going to tell you the stock is very expensive during recessions. And then it's going to tell you that the stock is very cheap during, the top of the market. So, you're going to be getting the exact opposite signal of what you should be doing. So like if I were to go back, to this chart here, these earnings got really low, right, in the wake of the great financial crisis in 2009, 2010. And you can see that the stock already started to move in advance of the earnings recovery. But if you were sitting there looking at, the traditional PE multiple, even if you were to look at forward earnings, forward PEs, you would start to say that, this stock is way too expensive. When in reality, the Shiller PE would have told you that this is a screaming buy during this drop right here. Because again, the Shiller PE is not concerned about, these temporary dips in earnings. It wants to look at earnings over a complete market cycle, over a 10-year period. So since it's using a 10-year moving average, these earnings are smoothed out, so it gives you less volatility, right? And so as long as the company continues to deliver mean reversion, meaning as long as earnings always come back to the mean, then these dips are to be bought. And whenever the distance between price and that normalized earnings reaches a peak, that's when the time is to be trimming that position. So if I were to go over here to the Shiller PE, you would see exactly that. So we look at Caterpillar Shiller PE over time, and you can see that the stock got historically cheap, right, in the midst of the great financial crisis. It got historically cheap again here in 2015, 2016. It got pretty cheap here again during the bottom of the COVID crisis. And right now we're basically right at the median level here. So we're basically right at where Caterpillar typically trades relative to its 10-year real earnings per share at about 21 times. So we're neither bullish nor bearish on Caterpillar right now in terms of its valuation. But you can see that I've overlaid on this chart, the mean right here, which is the center line. This is the mean over this 20-year period. And then you can see a +1 and +2 standard deviations from that mean, as well as -1 and -2. So you can see that the stock has historically gotten very cheap anytime it gets into this level right here. This is kind of like my buy zone for any company. So as long as you're picking a great company whose products and services are battle tested and best in class, even if they go through these deep cycles, buying them when they get into this sort of zone right here between 1 and 2 standard deviations below the long-term average over this 20-year period, it's been a great return over time. So if you bought this dip, you would have been handsomely rewarded. If you bought that dip, you would have been very handsomely rewarded in the following years. So the Shiller PE is a much better sort of long-term metric. If you want to know how a stock will perform, over the next not 1 to 2 years, but 3 to 6 years, then the Shiller PE is a much better timing tool in terms of understanding whether the stock is cheap or expensive. So my idea here is to look for companies that fall in this zone right here, this buy zone, which is a -1 to -2 standard deviation below the 20-year average. And I like to use 20 years because it gives you essentially 2 full cycles, right? Because we had one bull market cycle, which was during the 2000s, one bear market cycle during the 2008-2009 period, and then a 10-year bull cycle, in the 2010s, followed by the COVID, disruption, followed by the post-COVID, money printing era, followed by the current environment that we're in. So 20 years gives you a great view of valuation for any specific company. Obviously, this wouldn't work well for companies that have very short trading histories, but this is a great timing tool, especially for folks that are long-term long-term investors, but also tactical investors. So this is not necessarily a buy and hold strategy, but it is a strategy for tactical asset allocation. For example, you can look at the S&P 500 overall and look at where we're at, in the cycle for Shiller PE. So if I were to type in SPX here, you can look at exactly how cheap or expensive the S&P overall is, and you can see that this is one of the reasons why I've been, bearish on the market, is because, we're getting pretty heavy here. We got really heavy near the top of the market in late 2021. That's come in quite significantly since then, but now we're kind of moving right back up. So we're still well above the average over the past 20 years or so. And it's really only that because of, this era that we went through from 2017 to 2021. So 4 out of those 20 years, we were in a very, very elevated, state of, Shiller PE multiples. And we're kind of still bouncing it around in that territory right now. But I think that if earnings were to enter a recession, there's, as you can see here, there's substantial, multiple contraction that we can still endure. So anyway, the idea is that, the problem with traditional PE is that it's too sensitive to single periods, a single year, and that's going to give you the incorrect signal if we're at an inflection point, meaning if we're at the point where earnings are at a peak or a trough, then you're going to be getting the exact wrong signals. Because again, stocks look cheap when when earnings are at their peak, and then stocks look very expensive when earnings are at their trough. But in reality, that's the time to be buying, is when they look expensive on traditional PE. But the Shiller PE won't give you that false signal. It'll actually tell you when a stock is cheap during recessions or they're going through some temporary difficulty. So a great example is Clorox. So let's take a look at Clorox here. So I have just a screenshot of Clorox. The top panel is the traditional forward PE. So this uses the forward 12 months earnings expectations in the denominator, and then obviously price in the numerator. And you can see that Clorox is very expensive right now. You can see if you were to look at this chart, you would say, this is an all-time high PE. I'm not touching this company, right? It's trading at 30 times earnings, which it's never done in the last 20 years. So I don't want to touch this. But then if you look at the Shiller PE, look at that. That's telling you a very different picture, right? It got very expensive during the peak of COVID, right? And that was the time to sell it, by the way. If you look at the stock price, that was the time to sell it. And it went through a deep bear market, the stock price did. And now it's actually trading at a pretty good bargain, if you ask me. Now, it has had a little bit of a bounce back here, but this is why, when we, did a review of our earnings certain portfolio last year, one of the questions that some of our clients were asking is, are we still keeping Clorox in the portfolio? Because Clorox has had a lot of volatility in earnings. So if you look at this here, and remember, our ECP portfolio is optimized for low volatility in earnings. But look what happened to their earnings. We had this huge run-up above trend earnings growth, and that was due to the exceptional demand for bleach during the COVID-19 pandemic. And then look what happened to earnings as we reopened, as the pandemic eased. Earnings really dropped off a cliff, right? And so if you look at forward PEs, it looks very expensive. Like as we got that big drop off in earnings, let's go back here to this chart. You can see that during 2021 and into 2022 is when earnings really dropped. And so if you look at that, that's when the stock really started to look expensive on the traditional method of PE. But if you look at the Shiller PE, that's actually when the stock got very cheap. And if you look at right around 2022, it basically traded at the same multiple that as it got during the great financial crisis. So Clorox was a generational buy late last year, as it basically round tripped all of these, all of this earnings multiple expansion. And that's why we kept it in the portfolio. I took a look at that and said, well, this looks to me like a temporary difficulty. And that's exactly what they went through. Because there was exceptional demand for bleach, what they ended up doing is that they expanded manufacturing significantly to keep up with that incredible demand. But then as the pandemic eased, demand for bleach, significantly dropped off. And because they had all of this excess capacity, all of this excess manufacturing capacity, that really hit their net margins because they were running well below their capacity. So their capacity utilization went way down. So again, if you have fixed costs because of new manufacturing capacity and you're not operating at full capacity, then what that ends up doing is that it really hits your margins. So that's what happened to Clorox, and that's why Clorox went through this deep bear market. However, the reason why Shiller is so good is because we're not looking at these peaks and troughs here. We're looking at normalized 10-year average earnings, which if you were to plot a 10-year moving average onto this earnings line, it would cut right through the middle here. It would say, well, we're not paying attention to this artificial run-up, and we're also not paying attention to this drop-off here, because the moving average over a 10-year period would have all of that smoothed out. So we want to know what is the multiple relative to that 10-year moving average. So if you were to just imagine a 10-year moving average, my guess is that it would be somewhere right around here. So the multiple relative to that 10-year moving average essentially got, to the lowest it's ever been, really, in this 20-year period. You can see that it matched it very briefly, but it did get there, and it was actionable. You could have bought it with, plenty of time. And that's why, the Shiller PE is a much better metric to help you just, reduce the volatility when it comes to single year, reduce the impact of single year events on your valuation analysis. So again, I would look at Shiller PE whenever you're looking at any company. And if you are a PE type of a person, remember PEs do have limitations as well, even the Shiller PE. But if you are a PE person, you should be looking at both the single period PE as well as Shiller PE. And I would heavily weight towards the Shiller PE because that is the true that's the true multiple to long-term earnings. Especially if you're talking about generational companies. Remember, if you're talking about companies that are, passing fads, or if you're talking about companies that are, getting disrupted right now by new technologies, then the Shiller PE probably is not good because, again, the assumption is that earnings will always come back to trend. It will always revert back to the mean. So regardless of which company you're looking at, the Shiller PE, the reason why it works is because you're applying it to companies whose products and services are never going to completely go away. They're always going to come back to its mean. So that is true for companies like Caterpillar. That is true for companies like Clorox. That's true for many other companies, but it's not true for all companies. So there is a little bit of discretion that you as an analyst need to make with regards to taking the Shiller PE and making a determination whether the stock is cheap or not. So the question that you ultimately have to ask is, will this company that you're looking at experience a normalization of earnings? So if they're going through a temporary difficulty and the stock is down, then the Shiller PE could tell you that now is a great opportunistic time to be buying this company, as long as their earnings ultimately revert to the mean. So that's what happened with Clorox. We had this huge boom that led to rapidly rising earnings. As the pandemic eased, they found themselves with way too much capacity. Earnings came down. So again, traditional PE would have had you buy Clorox at the highs when it got cheap, quote unquote, due to its rapid increase in earnings. But then you would be selling it at the lows when it got expensive due to its earnings decline. So traditional PE would give you the exact opposite signals that you should be following. Shiller PE would give you the exact right, signals. So again, what are the pros and cons? The pros is that it's not sensitive to single period financial results. It uses real earnings, which I haven't talked about much, but the reason why we love real earnings as opposed to nominal earnings is because real earnings shows you the true value added that a company produces over time. Because a company could be growing earnings, but what if it's growing earnings at the rate of inflation? So that would mean that it's just inflation that's buoying the earnings growth, right? So if there's inflation in the market and the company's just simply raising prices to keep up with inflation, then even if they're growing earnings, at say 4% or 5%, right? We're currently at 5% CPI year over year. If they're growing at 5% earnings, well, the real earnings growth is zero in that case, because they're just riding the inflation wave and raising prices. So we want real earnings growth, earnings growth in excess of inflation. And that tells you the true value added that the company is producing over time. And again, it normalizes earnings over time. So we're using a 10-year moving average as opposed to a single period. Now, the cons is that it does assume that the company will successfully navigate its current period of difficulty. So as we saw on the chart of Clorox, we're assuming that it's going to have a recovery in earnings. So that we are assuming that this will get back to long-term trend. Long-term trend will be recaptured at some point. So that's what it assumes. So again, we have to do a little bit of due diligence and ask yourself this basic question: is Clorox the market leader in the industry that they operate in? Will the consumer go back to Clorox? Or will they ditch them for somebody else, right? So we obviously think that, yes, the consumer is not going away anytime soon. Clorox is still an iconic brand, even with companies like Target and Walmart that have their own house brands. Clorox still, continues to dominate market share in that, in that field. So again, and it also assumes companies' real earnings will ultimately experience mean reversion. So again, we have to ask that question to ourselves: is will that company be able to navigate the current difficulty and get back to growth? A great example of a company, by the way, that's going through this is Disney. Disney's earnings are down quite a bit here. You can see that, this huge drop in earnings. It really started in 2019, accelerated in 2020 due to the pandemic lockdowns, and it has rebounded ever since, but the stock is very cheap now. So this is due to multiple things kind of happening to get simultaneously. We had, Disney Plus as their primary focus. That's where a lot of spending has gone in. It's been quite expensive to build that online streaming service. And user growth has kind of disappointed a little bit in recent quarters here. But let's look at the Shiller PE and let's find out. Forget about this, 1 to 3 year volatility in earnings. Look at where the Shiller PE is right now. And it is definitely in that buy zone that I like to look for. 1 to 2 standard deviations below that 20-year moving average. So again, right now, Disney's going through some difficulty, but that's why the stock trades at a very low multiple to 10-year average earnings. And that to 10-year average real earnings. And you can see that it's almost essentially matching the average multiple during the Great Financial Crisis. In fact, it's slightly below the average here. You can see that it did get cheaper at one point, but very briefly. But the average during that recession was somewhere in this 20 ballpark, and we're right now well below that at almost 17 times. So again, if you believe that Disney is the category leader, and if you believe that Disney is going to continue to lead in culture, in entertainment, in media, in online streaming, things like that, everything that they do, as well as Disney parks and recreation. If you think that the company will continue to dominate those areas that they have excelled in for the past 100 years, then Disney right now is a terrific buying opportunity. Again, not a 1 year sort of time frame, not a very short term prediction, but if you're in a position for the next 3 to 6 years, I would say, over the next 3 to 6 years, this to me looks like a very attractive time to be buying Disney. So that is why I love using Shiller. Again, there's obviously pitfalls to basing all of your analysis on Shiller PE. But again, if you basically perform this very simple analytic framework, is this a generational company? Do they dominate the field that they operate in? And are consumers going to stick with them, or are they going to go away? If the answers to those questions are yes, then buying them when they get into this, deep buy zone that I like to look for here, 1 to 2 standard deviations, is going to typically be a great way to generate alpha long term over the 3 to 6 year period. So again, I would look for these types of companies that dominate their fields and are just going through some short-term difficulty that leads to their Shiller PE being very, very depressed. And just sit and wait 3 to 6 years. And I think if you assemble a portfolio like that of, anywhere between 10 to 15 stocks, you're going to get, some significant alpha. And that's just my view. So I hope this was helpful. What I did was I created a list of companies that, satisfy these criteria that I look for. So here are the criteria. I want to look for that buy zone, right? That, 1 to 2 standard deviation below the 20-year average Shiller PE. And then I want to look for companies that have proven to be recession resistant. So again, these are members of the earnings certain proxy that we maintain here at Zacks. So the collection of companies that have been generational transformers, companies that grow earnings consistently year in, year out over the past 20 years. So very stable long-term earnings growth trajectory. Also looking for strong balance sheet liquidity. So again, I want to make sure that the balance sheet is strong, and there's a ratio that I created, to help measure that, called the liquidity ratio. Looking for low beta, again, because I think low beta will outperform over the short term as well as the long term. As long as we're picking low Shiller PE, stocks. And then, any companies with buybacks and dividend growth is a plus. So I put together, I went through that, and these are the stocks that I found that match that criteria. You can see these are about 18 stocks here. So there's 18 out of the 75 from the Zacks earnings certain proxy portfolio. Again, companies with very resilient earnings long term, with a very cheap Shiller PE and very strong liquidity ratio. So here are the examples here. Amgen, very, very cheap. You can see that if you were to put that into the Shiller PE, Amgen is trading exceptionally cheap right now, and they have very stable earnings growth. So it's cheap and with high conviction with earnings. That's exactly the type of stocks I'm looking for. American Tower is another one. Church & Dwight is another one. And here's the liquidity ratio, which I define as cash on the balance sheet plus free cash flow minus dividends, divided by current liabilities. So that means that, for example, Amgen has 245% of their current liabilities available in cash and free cash flow. That means that if there's ever a time where we entered recession, and it's a prolonged recession, they've got ample liquidity to be able to deal with their short-term liabilities. So not all companies will have a ratio that high, but I was looking for anyone that has above, say 40 to 50%, which is typically considered pretty strong. So Disney passes that at 42%. Global Payments is another one I'm looking at very closely here. This stock is extremely cheap right now on Shiller PE. And so I think, there is a time to start to take a look at companies that have really gotten slammed hard and currently are trading in this buy zone area of 1 to 2 standard deviations below the 20-year mean. This to me looks like a great opportunity to be adding to names like this for the next 3 to 6 years, to buy and hold for the next 3 to 6 years. And again, these are companies that are, that dominate their fields. They are exceptional at what they do. ICE, Intercontinental Exchange, one of the, ultimate moat type of a business. Johnson & Johnson, also very cheap. 3M, very, very cheap right now. Waters Corporation, I love them, very cheap. So these are 18 stocks that you can consider in today's environment. And that's exactly the type of asset allocation that I currently recommend, is to stick to these types of stocks. So companies within the earnings certain portfolio with a low beta, with dividend growth and or share buybacks, with very cheap Shiller PE and strong balance sheet liquidity. Cross that with 1-year treasuries, which currently pay you 5%. It's very hard to turn that down right now. So I would be very, very closely looking at 1-year treasuries or a money market mutual fund. Be sure to look for a treasury money market mutual fund. That's my personal recommendation, because they invest only in U.S. treasuries with, a 60-day maturity or less, as well as repos with the New York Fed. That makes it very, very, essentially no risk. And so therefore, these funds won't get into any kind of trouble if, we were to enter some period of great liquidity difficulty. So I hope you found this helpful. And again, I'd love to hear from you if you have any questions or feedback. And if you have any ideas for a future video that you'd like to see I make in the future, please do reach out to us. You can reach us if you're a ZRS client at zrs@zacks.com, or if you are an Advisor Tools client, send us an email to zat@zacks.com. All right, thanks everyone. Talk to you soon. Bye-bye.